Welcome to the class. This is the part 2 of meaning of accounting class, accounting and auditing. In last class, we discussed the meaning of accounting, its features and about principles. In this class, let us discuss about the concepts, the accounting principles, which includes concepts and conventions detail in detail. Firstly, let us understand what are accounting concepts. To what things we called concepts. Accounting concepts are the basic rules, assumptions, and conditions that define the parameters and constraints within which accounting operates. Thus, accounting concepts are rules, assumptions, and conditions that the accounting operations or have the certain limit. Within that certain limit, all the accounting operations are to be made. That limits, that parameters, that constraints are said to be as accounting concepts. In other words, accounting concepts are generally accepted accounting principles which form the fundamental basis of consistently preparing the universal form of financial statements. So, these accounting concepts are the generally accepted accounting principles. All the accountants all over the world are accepted these concepts, and which forms the equal means unilevel universally form all over the world. There is one type of financial principles, accounting principles. These concepts are said to be as accounting concepts. Accounting concept principles underpin the reliability and integrity of financial information critical for informed business decisions. Then, detailed study on accounting concepts. The accounting concepts includes separate business entity concept, going concern concept, money measurement concept, cost concept, accounting period concept, realization concept, dual aspect concept, accrual concept, and matching concept. Let us discuss one by one. Firstly, separate business entity concept. Here, business is treated as a separate entity, that is different from owner. According to this concept, business is treated as the entity different from the owner. The transactions that take place affect the business and but not the owner. All the transactions which take place in the name of company are affects the business only. Here, owner is not responsible for that. That means it is not related to owner. Then, going concern concept. Second one. Here, business will continue for a long period. According to this concept, the business will continue for a long period to come, and it is not likely to be liquidated in the near future. Here, the concern, the business is always in continuation. Then, third one, money measurement concept. According to this concept, only those transactions which can be expressed in monetary terms are recorded in the accounting books, except those non-monetary transactions are not recorded here. Only the transactions which related to monetary terms are recorded in the books of accounts. Then, cost concept. Here, assets purchased are general recorded in the accounting books at the cost at which they are purchased. That is cost of the assets purchased. At what cost the assets are going to purchase. At what cost the asset is purchased, that cost are going to record in the accounting books. Then, accounting period concept. This concept is simply intended for a periodical assignment and reporting of the results of the working of the firm or business. Then, realization concepts. Only when sale is performed. According to this concept, revenue is recognized only when the sale is performed. After the sale of the particular goods or services, the revenue is recorded in the books of accounts. Then, dual aspect concept. According to this concept, every business transaction has the dual effect. Like assets is equal to liabilities, then assets is equal to capital plus other liabilities. For example, asset or capital is equal to assets minus liabilities. Dual aspects. Here, the business transactions have dual effect. Then next concept is accrual concept. Here all incomes and expenses should be recorded when they paid. According to these concepts, the incomes and expenses which should be recorded in the books of accounts when they paid. Before the payment of the incomes and expenses, they are not recorded in this as per this concept. Another one is matching concept. Here incomes are matched to expenditure. This matching concept is that to the extent feasible, costs and are reported as expenses in the period in which the associated revenue is reported. For example, cost of goods sold are matched with expenses of respective period and revenue. Income is matched with expenditure. Here the incomes and expenditures are matched to one another. That shows that how much the income is earned and how much is the expenditure has made by the organization. So these are the accounting concepts which are included in accounting principles. Then accounting conventions. What are accounting conventions? Accounting conventions are a set of industry best practices adopted by company requirements to serve as a guidelines to record financial transactions of the companies. So these are the practices, these are the guidelines that are adopted by the companies for their requirements to serve as a guidelines. These accounting conventions play a crucial role in transition to record financial transactions as per accounting standards in the company's accounting system. So, accounting conventions do not have any legal obligation, although the whole of the accounting industry is based around the generally practiced accounting conventions. We do not have any legal obligations. Then, accounting conventions have developed over time and change depending on the changing financial conditions. These conventions can be dynamic in nature. These can be changed as per our requirements. Then the accounting conventions promote consistency and comparability of financial statements across several domains. And further, the cause of accounting and bookkeeping professionals and also users of the financial statements in order to understand and draw conclusion from the financial statements. Accounting conventions are also called as accounting doctrines. The most important accounting conventions are consistency, conservatism, materiality, and full disclosure. So these are going to be discussed below. So there are four accounting conventions. One is consistency, another one is conservatism, another one is materiality, then last one is full disclosure. First one, convention of consistency. The convention of consistency provides that the business shall follow the same accounting principle and methods of upcoming accounting periods. Consistency helps the users of accounting to make conclusions and draw comparisons between financial statements of the different accounting periods. Here, a company should apply the same accounting principles across different accounting cycles. Once it chooses a method, it is urged to stick within its future unless it has a good reason to do otherwise. Without this convention, investors' ability to compare and assess how the company performs from one period to the next is made much more challenging. Then, convention of conservatism. Here the convention of conservatism provides that the company shall provide for all the probable losses. It should provide for all the probable losses and anticipate no profit unless it is going to be realized. This convention is based on being prudent. The business shall record all the expenses and liabilities when it sees uncertainty of incurring loss or liability. Here, playing it safe is both an accounting principle and convention. It tells accountants to err on the side of the caution when providing estimates for the assets and liabilities. That means when two values of the transactions are available, the lower one should be favored. The general concept is to factor in the worst case scenarios of the firm's financial future. Then another one is third one, convention of materiality. The convention of materiality states that businesses shall include all the relevant and material facts separately in the financial statements. Here, the businesses should include all the relevant and material facts separate in the financial statements. Material information refers to facts if those are being left out or interpreted in any other way other than what it is in the financial statements. It could lead to influence the decisions of the users of the financial statements. So these materiality like full disclosure. This convention urges companies to lay all their cards on the table. If an item or event is material, in other words important, it should be disclosed. The idea here is that any information that could influence the decision of a person looking at the financial statement must be included. Then the last one is convention of full disclosure. The convention of full disclosure provides that all the relevant and material information shall be properly disclosed in the preparation and presentation of financial statements. Each and everything related information about the financial transactions, about the organizational operations, everything should be disclosed for the preparation and presentation of financial statements. Financial statements are analyzed by various stakeholders as management, employees, debtors, creditors, government banks, and other verifiers, etc. Here, information considered potentially important and relevant must be revealed, regardless of whether it is detrimental to the company. All the information should be revealed for the accurate and correct preparation and presentation of financial statements. So this is all about the accounting principles. That includes accounting concepts and accounting conventions. So accounting concepts are those rules and regulations which are generally accepted, which should be followed by all the accountants all over the world. Whereas accounting conventions are those which are practiced, which are adopted by the company as per their requirement under the law. So that should be under the law, that should be acceptable by the organization, that should be acceptable by the law, that should be fair in the practice. So it's all about accounting concepts and conventions. Thank you dear students. Subscribe the channel, like it and share to your friends. Thank you.